The countdown is on. Everything you need to get the edge at the end of the market day. This is The Close.
A global market awash in liquidity outweighs a globe mired in military conflict. Live from Bloomberg headquarters here in New York. Yes, they are still our headquarters in New York. I'm Romaine Bostic.
And I'm Alex Steele. Yeah. Let me tell you, nothing going on in the market, guys. You just look at the passivity within the equity market. Flat on the day, even the VIX is lower despite any headline risk. No moves nowhere fast on the second day of October. The action, though, Romaine, is in the bond market. You got that bear steepener, so a sell-off across the curve at the back end sells off more, and those yields move higher. You can see that inversion there hitting about 14 basis points.
Yeah, you missed a lot of action yesterday while you were on assignment. You take a look at the S&P today, trying to get back on track after that Middle East violence knocked the S&P off its record high that was set on Monday. Now, while the price action on this Wednesday is lukewarm, strategists are standing by their bullish targets. And Goldman Scott Rubner, he's actually going a step further, saying his year-end target of 6,000 for the S&P, that might actually be too low, particularly if seasonal headwinds fade toward the end of October and corporate buybacks pick back up. Meanwhile, a national holiday has done nothing, absolutely nothing, to interrupt the equity rally in China. While mainland markets are closed, Hong Kong is open and the Hang Seng is rallying, gaining 31% in the past 13 sessions. UBS strategist Shane Carroll says this is just the tip of the iceberg. China stocks, they're still miles below all-time highs set years ago. They've got a lot of room to run. Carroll recommends buying call spreads and call ratios on the K-Web ETF that tracks China tech stocks. And with U.S. stocks right around record highs and Chinese stocks rebounding from a months-long slump, some investors are scratching their heads as to why central banks are easing monetary policy right now. John Farrell caught up with Apollo CEO Mark Rowan earlier this morning and posed that question to him.
It is not clear that we need more rate cuts at this point in time, and to the extent we encourage growth, and growth was very strong, as you saw from GDP for the quarter. To the extent we accelerate the economy and have to go in the other direction, that would not be a good day.
Just pause. You think the Fed might have to start hiking interest rates again in 25?
I'm not saying that yet. I'm just saying I see no reason for the cutting of rates right now.
Mark Rowan speaking a little bit earlier here on this network. Joining us right now to kick us off to the close is Kate Moore, head of thematic strategy of the global allocation team over at BlackRock, joining us today in Studio 2. Kate, great to see you again.
Yeah, great to see you.
A lot of people are really parsing that latest rate cut by the Fed, and more importantly, their forecast for pretty aggressive rate cuts over the next 12 months. I know your camp is still kind of married to this idea that the Fed will continue to cut at least through January. Why?
Yeah, look, we think there has to be a recalibration, that the inflation picture and the labor market picture are really sort of supporting the case for further policy easing. But I think some of the market pricing in terms of the aggressive cuts into 2025 is getting ahead of itself. And I think you've heard that from a number of different market participants over the last couple of days. They've said, actually, growth is in a pretty good place, and the market pricing has gotten a little ahead of itself. Look, people ask me this all the time, and we think about this all the time in the fund. You know, are there really significant signs of weakness across the equity market? Are you seeing industries or sectors that are showing, kind of red flags? And we aren't. Now, I'll be watching really closely as we go through earnings if anyone really talks about taking down their forecasts. But I think the calls for the consumer demise have been way overdone. In fact, consumers are just being smart, value-oriented, and spending on the things that they like. And companies have been holding off slightly on CapEx, mostly because they want more clarity on policy, and particularly U.S. policy into 2025, rather than seeing a significant decline in terms of their overall revenues. So I just don't see anything that's necessitating a massive slash in policy rates. When
it comes to allocation right now, do you have the confidence to be aggressive right now, or do you wait, given the election cycle that you just mentioned, the earnings season that's going to bring a lot of commentary and just the general year-end type of shenanigans, if you will?
Here's what I'll say.
Yeah.
There's October 2nd, Kate, which is going to be a little bit more cautious over the next couple weeks. And then there's kind of the 6-month Kate, which is much more constructive. Look, I think there are a few things holding us back in October. We have the technicals, frankly, around mutual fund, fiscal year end, where you get the tax law selling, which obviously can be a bit of a headwind. You have this blackout period we have ahead of earnings. We certainly have some concerns on the fundamental side. We just need to make sure that the earnings continue to hit the mark and that revenues are not decelerating rapidly, which was a fear coming out of second quarter reporting. geopolitical concerns, of course. And then really, really critically, I think we need to see people feel confidence in stories outside of what they've invested in and what made money in 2024. So a broadening out of the market. So all of these things together are going to really sort of combine, I think, to dampen a little bit risk appetite. Not kill it, but dampen it over the next few weeks.
So the next few weeks, okay, it could be pretty dicey. But on the whole, we're still seeing a ton of liquidity and excess liquidity within the market. And no matter who, say, gets the White House, there's going to be fiscal spend, just maybe in different ways.
Absolutely.
So is there like a risk that inflation picks up, that we reaccelerate growth?
I think it's a non-zero risk. That's my way of saying, yeah, it's something I'm watching. It's like
and it's not hedged at all. Like it's not priced in anywhere.
People are not expecting prices to stay either buoyant or, and perhaps in some cases or specific commodities or areas, to actually increase. Look, on the whole, we're expecting a disinflationary trend, less inflationary pressures. But your point is fair, Alex. Like there are some areas where, according to demand or supply disruptions, you could end up seeing slightly higher prices a month or two from now. And I think that's a real risk we have to weigh when we think about policy easing and when we think about the equity versus bond discussion.
What do you then think of the equity versus bond discussion based on that?
I still think that equities perform the best, even in a slightly higher inflation environment. You know, most of these companies may not have the same pricing power they did, 3 or 6 months ago or even 9 months ago, but they're largely able to pass on some of their input costs, especially if incomes continue to be pretty well supported. And I have full confidence in U.S. companies to use all their levers, to use every dial to manage to their bottom line. This is what we saw in the second quarter. I wouldn't bet against companies managing to their margins, even if prices are a little bit higher.
To quibble with that, though, it seemed like that was more the largest of the large cap companies that were able to do that. And I know there's been a lot of talk about the rally broadening to some of those mid cap and small cap names, companies that, at least on the surface, didn't appear to be handling things as well as the larger companies.
Or mainly be clear, when I talk about the broadening out, I'm not talking about a size broadening out because I am not as constructive on the smaller companies. I'm talking more about the sector broadening out.
Gotcha.
And, the small side is really difficult. 50 basis points, 75 basis points, 100 basis points of cut are not game changers for companies that don't have the cash to invest in technology, who are more of the labor price takers in general, and who frankly tend to be in parts of the supply chain where they have less leverage. So that's not to say they're not good small and medium-sized companies. I want to stock pick those and take idiosyncratic risk. But talking about entire size when there are more structural issues facing companies with similar types of balance sheets is a hard one for me.
And to your point, though, about the strength of the economy, when we talk about 50, 75, 100, whatever we're going to get over the next few months here, that might not be a game changer for some of those companies. Will that be a game changer for consumers? Are they going to feel that? In a good way, I mean?
Some will start to feel it, but you know this as well as I do. So much of consumer debt, or the majority of it, is kind of mortgages. So much of that has been locked in at fixed rates. It's not like everyone's repricing their mortgage debt. Do they feel a little bit better on the margin because of maybe their credit card interest rate? Maybe, but I'm not banking on that. I'm more betting on a solid labor market and actually continued income growth.
This is also that part of the show where I just have to mention that I just got an alert from my high yield savings account that it's gone down.
50 basis points.
The second one in
my money market fund as well.
But it's still over 4, so I'm not in it anytime soon. But I'm talking about it, and I'm like, where am I going to put that money?
I'm starting to make some personal rotations there.
Okay, so but that's a real question. Does that money come out of those high yield savings and money market funds, and how fast and where?
I think we'll get a little bit out of it, and I think the most likely beneficiary, frankly, is the equity market. I mean, people have been swapping out a little bit on the bond side, but I would say more of it is saying, hey, look, equities in general tend to perform well over the long term. There have been a lot of great articles out about the compounding of equity returns over the last 1, 3, 5, 15 years. And people need to take that message on board. If there's any weakness, if there's any air pocket going into year end, I think it's an opportunity to average in.
All right. Kate Moore, we're just getting started here, head of thematic strategy of the global allocation team over at BlackRock. She's sticking with us. When we come back, we're going to have a broader conversation about what's been going on overseas, that phenomenal rally in China. Stick with us. This is The Close on Bloomberg.
China China's stimulus blitz has handed more than 25% returns in September to some hedge funds. A huge move. We got the Golden Dragon Index, a gigantic move in just that 1 month. Want to bring back Kate Moore, head of thematic strategy at the global allocation team at BlackRock. Is it all in China right now?
I think people are excited about a rotation into China, but I have to tell you, I'm not a buyer. I mean, I know there are people at BlackRock who are saying this is a renting opportunity and they're going to be tourists, and that's great. But I think there are better opportunities, frankly, still in U.S. equities. I understand that Chinese equities are cheap from a multiple perspective, but sometimes stuff is cheap for a reason. And I'm so thankful that the Chinese government has decided to put a floor in the economy. That's necessary for overall global growth, and I think that's very supportive of some of the global names that I love. That said, you know, we're in a bit of a show me period for China. Like, we've had some false starts, we've had some big promises, and then we haven't had follow through. So I'm okay if I miss part of this rally if I'm focused on the bigger beneficiaries from China not falling through the floor.
Okay, so what about the U.S. companies with exposure to China? Like Bank of America just upgraded materials. They have one of the best betas, they're the top sector related to China, and they've underperformed in certain months. Like, what do you think about that? I
mean, that's historically been the right playbook, right? Resources have been big beneficiaries. I'm not super convinced that that's China's playbook going forward. Spend, spend, spend on materials and infrastructure. And I think a big thing that we need to remember is that the U.S. election is a massive policy event. You know, the relationship between the U.S. and China and what that does to global trade and to global growth is a big question mark. I think under either administration, we're going to see some changes in 2025. So I'd be cautious about making a very big long-term investment before we see the policy move.
I understand that the U.S. might be the best game in town, or in the world, or whatever the phrase is here. But are there opportunities outside the U.S.? I mean, for those who want a little bit more diversification beyond their home, meaning for U.S. investors, is there somewhere else to go?
Definitely. Yeah. I mean, we've enjoyed taking risk in Japan throughout this year. We've dialed up and dialed down at different times. We see big opportunities there, and I frankly have a little bit more confidence in the government's policy to actually
in Japan.
Yeah, to get to where we are, a better story in growth. We've also been adding to exposure in India. We think India is a beneficiary of many different things. Obviously, it is a strong domestic story. People kind of cringe sometimes because the multiples are high relative to the rest of the world, but is also being going to be a big beneficiary, I think, of U.S. multinational spend. Everyone is looking to build facilities and expand their footprint there. BlackRock continues to make big investments. I see India as an area to add.
Is there, when it comes to the India story, because I know there are a lot of people that want to draw parallels between kind of all the hype around China and its population growth and the growing middle class and saying, well, India is basically China 2.0 to a certain extent, maybe even better. What makes India potentially a better play than a behemoth like China, which is still the second largest economy?
Yeah, I mean, one of the things I'm most excited about in India is the broadening out of that market. I mean, when people have looked at the equity market before, they've said, okay, there are a couple of big companies, they trade at a huge premium maybe to their global peers. Yes, they produce strong earnings and they have good fundamentals, but like, I'm buying just a couple names. What I've started to see in India actually is a broadening out on the size spectrum where you're getting more mid-cap and small-cap opportunities, more consumer companies that are well-funded. And I think as the Indian consumer moves up the income spectrum and government policies continue to support the low end, we're going to get a greater breadth of Indian equity to invest in.
To go back to Japan for just a second, because there's been some questions as to how the carry trade unwind is actually going to work, and if we're going to see like an early October thing again, or if we're going to see just sort of a slow move of money back into Japan. What do you think?
I'm not expecting anything that's particularly sharp. I think a slow rotation makes a lot more sense. And what I like is that a bunch of the Japanese companies that we're invested in and that we've had in the portfolio are really multinationals. They are not just plays on the Japanese consumer. I know that has been something that we've looked at in the past, but these are companies that, frankly, do well if the rest of the global economy is in good shape and if they have a technology advantage or great partnerships with their U.S. counterparts. I think that's an advantage. So
you don't need like the BOJ to hike again for this to work out.
I think that's a support, but we're investing really in high quality companies at this point, not just the overall kind of beta trade.
Is there, and I just want to, we only have about 30 seconds, but I do want to go back to the policy question here, because everything we're talking about here, obviously a lot's going to be reshaped, not just by the U.S. election, but all the elections that we've had this year. Do you see sort of a reorganizing of kind of the global world order, or is that overstating what's been taking place?
I think some of that reorganization has been taking place over a number of years. I suspect some of it will accelerate in 2025 after the U.S. election. But of course, as we know, a lot of that depends on the composition of Congress and how much any administration is able to get done.
All right, Kate, a great conversation as always. Kate Moore, she's head of thematic strategy of the global allocation team over at BlackRock, kicking us off to the close here on this Wednesday afternoon. When we come back, we're going to continue to keep an eye on what's going on with the dock workers strike, a shutdown of the East and Gulf Coast ports, and the effect, Alex, on the nation's economy.
All right, Plus traders putting a big bet on $100 oil as tensions in the Mideast continue to escalate. We're going to break down oil's possible price action over the coming weeks.
And as stocks rally, well, the deal-making space is also getting, well, a kick in the pants. Avinash Mehrotra, global head of activism and shareholder advisory and takeover defense practices over at Goldman, he's going to be stopping by to give us his outlook for 2025. This is The Close on Bloomberg. All right, let's get a view from the sell side with our top calls, big movers on the back of analyst recommendations. And we start off today with Mobileye, cut to underperform over at BNP Paribas. The analyst saying this was a major reset year for the maker of self-driving technology, and he sees more headwinds on the way. Disappointing volumes from Porsche and Volkswagen, coupled with slowing growth in China and Europe, putting more pressure on the bottom line. The share is moving lower by about 2% on the day. Next up, Zim Integrated, a marine shipping company, getting a cut down to hold from buy over at Jefferies. Jefferies actually saying that when you consider that the stock has more than doubled this year, and of course the start of that port strike, valuations are pretty much where they're going to be for the foreseeable future. He adds that negotiations with the dock workers unions are still ongoing, but the risk of further freight disruption seems to already be priced into the shares. Price target set at $25 a share. The share is moving down lower to around 23 and change. And finally, let's take a look at Sphere Entertainment. Wolf Research upgrading to outperform, saying that Sphere has proved to be a utilized, efficient, and profitable venue relative to a traditional arena. And they believe that the best is yet to come as more content is created, letting the venue appeal to larger audiences and eventually expand. The shares expanding by 5% on the day, and those are some of our top calls. All right, let's switch to one of the big stories that was in the after hours trade today, spilling over into the cash session today, and that is Nike. Shares unraveling after the sports apparel retailer shocked investors by withdrawing its full year guidance and postponing its investor day. Zachary Warring joining us right now. He's equity analyst over at CFRA. He's out with a fresh downgrade on the stock, down to hold from buy. I guess the pulling of the investor conference and even the pulling of the guidance, not a total shock, given that they have a new CEO who hasn't technically even started on the job yet, Zachary. But give us a sense here that once he is in that seat in a couple of weeks and he has a chance to really get a lay of the land, when, if at all, do you expect him to provide some sort of meaningful update onto the long-term forecast for this company?
Yeah, thanks for having me. I think it's probably going to be in 2025. I don't see, him coming in and, having an investor day before then. It's just they report usually late in December. You could get a little bit of guidance there, but I would expect for them to kind of move that investors day to early 2025.
When you look at the drop that we saw in sales growth, the 10% drop overall, you had to go back pretty far in time to see a string of quarters where we've had a negative sign in front of it, and you've seen the company struggling like this. What is a turnaround plan in your mind that would sort of arrest that drop and put them back onto a path to growth?
Yeah, well, I think they're going to get a little bit of help out of China with the recent stimulus there. So you might see a little boost out of China, which has been kind of a drag on their earnings over the past few years, which was expected to be kind of the leader for them, which was, kind of disappointing. But, we do think that the U.S. is saturated. You'll probably see a little bit of growth in line with GDP there. Europe is a little bit saturated as well, maybe not quite to the level of U.S. So you could get a little bit extra growth out of Europe, but really you're going to look to Asia and some of these other, maybe Latin America and some of these other areas to lead growth.
Zachary, when do we know that Nike's hit the trough of their revenue and sales decline?
They said that the spring order book was light, flat year over year, which to me, you're probably looking at the trough in these next quarter or two. But it's tough to call. We think this spring you'll start to get some of this talk from the CEO, about long-term strategy and where they're really going to try to tackle some of the growth. And then, like I said, I think China is going to be kind of the near-term catalyst for them. Maybe, in January, February, you get a little bit of commentary out of China and see, how that's doing and how that's performing after this stimulus.
And so to that point, what does the trough look like for the stock? We're trading at like 83 anyway, and we get this announcement and we know it's coming and the stock is still down kind of 6%. What does that bottom wind up looking like?
We really like that $72 level. We think, that's probably a pretty good entry point. We think their earnings are going to hold up all right over the next few quarters. They're probably not going to do better than $3.50 a share over the next year. But that's not terrible. The company's still a leader across multiple categories. They talked in their earnings call about how running was actually a strong point for them, which, you've heard a lot of competition calls out of analysts and investors, myself being one, from Hoka and on. But they see strength in the running category still. And you're not seeing a lot of the elite runners switch to these other brands. They still wear Nikes. You look at marathon runners, some of these other Olympic runners, they're all wearing Nike still. So we still think they're a leader. They have a really great balance sheet. They're doing about $4 to $5 billion a year in buybacks. Yeah. So that's kind of going to, I think, keep the shares elevated from that level.
Just real quickly, though, on the fashion side of this, because obviously that's a huge part of their business, if not the bulk of it. A lot of folks like me who just buy the shoes because we think they look good. Do you think that Elliott Hill can sort of get that side of the business back on track, to get that cachet back?
I think so. They've come out with a lot of commentary about how well liked he is at the company. So I think he'll get those teams pointed in the right direction. It'll be interesting. They did comment on Jordan, the Jordan brand, and how they expect, Jordan to be down double digits this year. And so that was interesting to me. I thought, Jordan had been a real strength for the brand. Yeah. And so that was interesting. But I do think next summer we're talking differently about Nike. I think he'll have, a long-term plan in place. I think, revenues will have troughed at that point, and I think you'll start to see some margin improvement as well.
All right, Zachary, thanks a lot. Really appreciate it. Zach Warring over at CFRA. It's almost like Nike could be like that front line for China, right? Like they really need China. So it's a great way to see if the stimulus might actually work. Yeah, absolutely. And look, Nike will bounce back. It's obviously a huge legacy brand, but it's just a matter of getting, I think, some of that cachet back. I want the sneakers with the stilettos. But Nike doesn't make those, right? Is that it? All right. I don't know. I've never looked at those I don't think so. All right, coming up, Avinash Mehrotra is co-head of M&A Americas from Goldman Sachs. Will join us about what's in store for the cycle. This is The Close on Bloomberg.
We have begun to see this increased rebound in activity. There's going to be a lot of activity below that top 10 group. And there's a lot of liquidity on the sidelines waiting to jump into this. You think 2025 in particular is going to be really big for that. A lot of these companies are very richly priced. And also companies, while public, have been engaging in so-called private equity strategies. They've been doing massive cost cutting over the last couple of years. They've been putting big investments in marketing, R&D. They've been returning money to investors. The interest rate pivot is going to be a catalyst to see more activity. I do think that there's greater confidence and probably greater sense of urgency to look at M&A, to look at other avenues for growth. It's hard to pursue M&A if you don't know what your growth rate, your profitability rate is going to be. To pick up another company and then try to figure out how to meld that in is difficult.
Just about 3:30 p.m. here in New York. This is the countdown to the close. I'm Romaine Bostick.
And I'm Alex Steele. Those are some of our previous guests that we've had on M&A. And there was a great article out on the Bloomberg Terminal about JP Morgan saying that private equity firms that are looking to offload could also be looking at the IPO market if we broaden it out to investment banking. Yeah,
and it's interesting, too. I mean, when you think about where the stock market is right now and the idea that yields are coming down, and, of course, all of these companies that are still kind of in that sort of private space right now that under normal circumstances would have come out, you understand why a lot of people, at least the deal makers on Wall Street, are excited right now.
Getting excited. Yes. Let's talk to one of them right now. We're going to talk to Avinash Mehrotra. He is Global Head of Activism, Shareholder Advisory, and Takeover Practices, as well as Co-Head of M&A over at Goldman Sachs. Avi, thank you so much for joining us. It's really a pleasure to talk to you.
Yeah, great to be with you all.
Okay, so what is this rest of this year and next year going to look like for M&A?
So actually, we're quite constructive on the outlook because if you think about what's really been going on through the balance of 2024, we've been steadily building momentum across M&A. It started really around this time, late last year, with the natural resources space where we saw some big deals get announced there. And I think from there, it's broadened out to financial institutions, industrials, tech, media, and telecom. So we're expecting a more broad-based level of activity going forward.
And are these like transformational deals, or are these going to be sort of bolt-on deals? Because it doesn't feel like the FTC is like all in to like a big transformational deal.
So I think it's going to be both. You know, companies are very focused on their strategic competitiveness. You know, many of these industries are very globally competitive. And I think you need to have transactions that both increase your competitiveness and maybe even reshape the industry. So I think you're going to see a little bit of both. And depending on the administration, you know, maybe there'll be a different posture on the antitrust outlook.
But I feel like at least strategic type deals right now, I mean, they are kind of a hard sell. I mean, you know, you take something like, you know, Kroger, for example, you know, you can make a case, at least from the company's perspective, of why that was a great deal. You have a Tapestry and other companies out there that, to a certain extent, are fighting for survival. And then they're up against this regulatory wall right now because, you know, they're concerned that, I don't know, you might have to pay extra for a purse or a stiletto heel or something.
Yeah. Right.
Sneakers, stiletto sneakers.
Yeah. Right. You know, the way I would think about that is that, look, absolutely antitrust is a consideration. Yeah. But at the same time, I think that if you're the first mover, for example, right, and if you can help reshape the industry, as we think about the chessboard in many of these industries that we look at, there is room for consolidation that is well beneath the area that we think will get into antitrust scrutiny. And we haven't even talked about private equity, which I think can play a big role in this as well.
Well, let's talk about that because they love to talk about it. I mean, they're kind of chomping at the bit right now, particularly given how market conditions have changed for the better, how economic conditions have stabilized here. Are we going to see a lot come out of that private space into public markets, or are we going to see more consolidation within the private space itself?
So the way I would think about this is if you stop and look at the amount of dry powder that private equity has, it's over $1 trillion, right? If you think about not just the quantum of that capital, but the fact that over 25% of it has been sitting around for 4 years or more, there's a lot of pressure to put that to work. The other thing to think about is there's a huge opportunity for private equity because even if you very conservatively lever that $1 trillion of dry powder, you've got $3 to $4 trillion of purchasing power there. So I think you're going to see private equity continue to operate on the P2P front, which has already been very active this year with that dry powder. But also as the capital markets start to recover, you're going to see their portfolio companies, which they've been waiting to monetize, in some cases go out publicly through the capital markets, right? And that can lead to activity really on both sides.
If we do start to see that in a meaningful way here, when do you expect that to actually happen? Because, I mean, the writing's on the wall right now. Do they wait for, I don't know, what, the election to be over? Or what are they waiting for? Do they need a green light?
I don't think they do, in fact. There were some inflation concerns, but, you know, those are largely behind us right now. The Fed has stated its posture on that. I think the election is an uncertainty, but we're talking a matter of weeks. But I think as we get late into the fourth quarter, early into the first quarter, inflation concerns are now much more muted. The election uncertainty will be behind us, and I think we'll have a path forward.
Talk to us about your other part of your job, which is activism, right? Are there a lot of more activists in equities right now? And I guess the question is, like, why?
So this is a strategy that many hedge funds have looked at a little bit, you know, occasionally, and they've reached the conclusion that the strategy works. And we're seeing new and occasional, or what we call first-time activists, jump into the fray increasingly. So I would say overall, there's been a proliferation of activist funds out there trying the strategy. Now, we certainly have the traditional activists, the names that we've heard of, such as Elliott, continuing to play, but not only continuing to participate, but they are moving at a record pace. If you just think about the amount of activity that we've seen just from Elliott this year, it's probably in excess of one major campaign per month.
So that feels huge. And in terms of then how it relates to M&A, do they want those companies to get bigger or smaller?
So I think there's a trend right now outside of activism with the long-only investors, if you will, to simplify companies, to streamline companies, to say to companies, maybe you're in too many business lines. Let's examine whether you need to be in all of these business lines. Even with the Fed move, the cost of capital today is a lot more elevated than it was a couple of years ago. Means that companies have got to be a little bit more disciplined about putting that to use. And so it's not even the activists that are pushing companies to simplify as much as it is the broader investor base. So I think that you're going to continue to see companies divest businesses, sell businesses. You've got a vibrant private equity market that's waiting to absorb some of those businesses. You've got a capital markets that I think is going to be functioning in a more robust way. So it can lead to activity really on all sides of that.
Are there certain sectors that are going to be more ripe for that type of divestiture, spin-off kind of environment?
None that I would really single out. I would say that any time you see companies with multiple business lines, big geographic footprints, and if they're underperforming, someone is going to force the question on them as to whether they need to take a look at the portfolio.
I find that interesting because that's a huge shift from, kind of what transpired over the last, 50, 60 years where you had kind of that conglomerate model. And I know there's been a lot of stories written, obituaries written about the conglomerate model. Is there not value in that anymore? I mean, the idea that if one business isn't doing well, the other one sort of picks up the slack, that's just over?
So you're talking about diversification. And I think there is a place for diversification. But this idea of having far-flung businesses that don't have adjacencies and don't have synergies, that's what's being questioned. And I think the bar is just higher right now. You can still have a business with different business lines, but the bar for you to justify that to your investors is higher. It's harder in a higher interest rate environment. And also, when you think about valuations, a really interesting point is that sometimes pure play companies tend to trade at higher multiples than diversified companies.
That's a good point.
Until the downturn happens, and then you want the conglomerates because they have different sides of their businesses. Before we let you go, I wanted to talk about what you think M&A and energy sector is going to look like, because from a stock investor point of view, it's hard to own multiple energy stocks. So the idea is you have to, as the company, outshine the rest, and that's just going to be bigger is better, particularly when it comes to those assets in the Permian Basin, for example. Are you expecting that to continue, this M&A and energy world?
So I would think of the energy world, we're talking about lots of different pockets of subsectors within energy. Overall, I agree with your observation that scale in an industry like that is really important. And so I think you've already started to see the beginnings of that with some of the deals that we looked at last year with the majors. I think you'll see more consolidation. There's more consolidation to go, but it's not only based on the Permian. It's based on other dynamics such as renewables and everything else that we're struggling with from a climate change standpoint. It favors scale to make those kind of investments and to have the durability to see those investments through over long periods of time. So I think you'll see consolidation driven by all of those factors.
All right, Avi, great conversation. Really appreciate you taking time for us. Avinash Mehrotra there over at Goldman Sachs, who helps lead a lot of their M&A and takeover defense practices. When we come back after the break here, we're going to check in on one of the big movers of the day, and that's ConAgra. The share's down 8%. This after a very interesting warning by the CEO on a challenging environment after the packaged food company missed on earnings expectations. It's our stock of the hour, and it's up next, right here on The Close on Bloomberg. Let's take a look at our stock of the hour. Shares of ConAgra down about 8% right now. This is the maker of the brands like Slim Jim and Healthy Choice Meals, missing analysts' expectations for earnings. But more importantly, the CEO, Sean Colling, really warning of a challenging environment for packaged food sector writ large. Jess Menton joining us right now, who helps lead our equity markets coverage here at Bloomberg, to talk a little bit more about what's ailing this company. It's a pretty long list of things. They got issues at their hot dog factory, their edible butter fats business. They've seen deflation there. And then, of course, just packaged foods overall. Is this just all about lack of pricing power on their end?
Because that's the big thing. Even Tom Barkin from obviously the Richmond Fed, he was actually, I did an interview with him in the first half of the year, and he said when they were still looking at what inflation was telling them, he was looking toward consumer packaged good companies. And Jen Bartashis at Bloomberg Intelligence was watching in the second half of this year, because a lot of these companies, a lot of the margin pain was happening, obviously because of those margin shredded inflation pressures. But they wanted to, when you're moving away from trying to pass on those costs to consumers as inflation is ebbing, what do you do? Because you want to support those margins. So the big thing was price mix and how do you up your volume? So a lot of them have been trying to pass on those discounts, like say if we're at the grocery store, buy one, get one 50% off, things like that. Not just ConAgra, but other groups that are in that space. phase
that's what
two.
I don't understand. Was this just, I mean, they had raised their prices. So is this just a matter, I mean, prices are still elevated. They're just not as.
The volumes weren't picking up as much as they thought that they would, despite some of the not passing on those costs as much. And that's some of the issues. You mentioned hot dogs. Obviously, they had some issues with the Hebrew National. That's where those hot dog issues, as far as they took actually a $27 million charge because of that was shut down. But now it's reopened too. But y'all also mentioned some of the oil sort of butter related, either if you're thinking about Earth Smart, these different sort of butter products, they're actually seeing deflation in those types of categories that you normally wouldn't think of, but they actually have permanent price cuts for that. I know you're not that much of a fan for that, though, Alex.
You were saying edible butter.
Edible.
I
think it's kind of like the type of term that they use.
I'm looking at the transcript from their conference call. They refer to edible butters, edible fats.
Smart balance and earth balance. Those are kind of the key words that they were
non-edible butters,
so
right?
that's how they kind of classify
Shea butter? Do shea butter? Cocoa butter?
No, it's fair. No, I do eat earth balance, so there is that. So there's a distinction here between an idiosyncratic problem that they had with some of their manufacturing issues and then the broader consumer. They kind of maxed out on their pricing.
And if you look at how the group is doing relative to the S&P 500 this year, it's underperforming it by about 16 percentage points. That would be the second consecutive year of underperformance for the broader market in 8 of the last 9. And a lot of that in recent years has not surprisingly been because of coming out of COVID and the margin pressures and passing on those costs. I mean, still, though, if you're going into year end, a lot of those companies are still having to grapple with this.
Yeah. And it's interesting to see a lot of the other packaged foods companies moving lower on this as well.
Yep.
So
that edible butter stuff, it's important. All right, Jess, thanks a lot.
Just mentioned popcorn, Orville Redenbacher's. You eat that?
Popcorn.
Boom Chicka Pop? That sounds healthy. I know you're Miss Healthy. That's okay, there you go.
Although I'm really inside somewhat unhealthy. So as we head into the close here, guys, I just want to point out the yen is now down 2%, the worst drop since October 7th. This is quite something. Potentially a less hiking need came out from the government. So we'll see if that continues.
All
right, coming up, we're going to count you down the closing bell. 15 minutes away. Ellen Dunn is co-head of value equity and senior portfolio manager over at Morgan Stanley Investment Management. Equity is honestly going nowhere fast. This is the close on Bloomberg.
I still think that equities perform the best, even in a slightly higher inflation environment. You know, most of these companies may not have the same pricing power they did, 3 or 6 months ago or even 9 months ago, but they're largely able to pass on some of their input costs, especially if incomes continue to be pretty well supported. And I have full confidence in U.S. companies to use all their levers, to use every dial to manage to their bottom line.
That was Kate Moore over at BlackRock kicking us off to the close just about 50 minutes ago, giving us her perspective here on market conditions. In her view, things are looking actually pretty good.
Yep. In the market, so you wouldn't know it. I mean, nothing is happening. If you look at the broader index, if you look at kind of what's moving and what's not, you have tech outperforming, shocker, and then you have consumer staples lower. That's a ConAgra story at the end of the day. But I was struck by even SMIDs, small caps and mid caps can't seem to get a bid. It's like everything is just stopping for a second.
SMIDs.
I did do SMID. Yeah.
Okay. All right.
Does that make me cool?
You're one of those.
It makes me feel cool.
I mean, in certain parts of Wall Street, yes, you are cool, Alex. But I don't know. You don't want to go walk through Brooklyn saying that. All right, let's keep this conversation going here with just about 9 minutes until those closing bells. Ellen Dunn joining us right now here in Studio 2. He's co-head of value equity and senior portfolio manager at Morgan Stanley Investment Management. And to Alex's point, Ellen, and I want to pick up on that too, when we talk about what this market has done. And you go back to the beginning of this year where all we talked about was big tech, where the Magnificent Seven. But over the past few months, when you look at the top of the leaderboard, you've seen a broadening of this rally. You've seen utilities, you've seen real estate, you've seen materials here. Is that a value trade or is that a defensive trade?
I think it's both. I think it's a rotation of the market and it's the opportunity set that's present. So when you have such a top-heavy concentrated market, it presents a lot of opportunity for stock pickers like us. That's what we've been seeing. We've been talking about that all year. Now, in the summer is really when that started to come to fruition, partly on the back of the expectations of falling rates potentially, but also it's the concept of there's a lot of other good things that are going to come out of this big data center trend. And so that's what we've really seen, I think, is this really rotation in the market. You've seen some of the rate sensitive stuff like financials do better, utilities do better. Utilities also have done better because there's a big secular growth story there, right? So we like the barbell idea here in the market. There's a lot of volatility, a lot of interesting things going on that we would say, you can buy cyclicals and defensives and do quite well here.
Well, I mean, it's interesting because when we were talking to Kate Moore, she talked about this idea of this being a stock picker's market, particularly when it comes to SMIDs, as Alex would say here.
Cool kids.
The cool kids would say.
Yeah.
I mean, can you give us some examples of specific stocks where you are finding that type of opportunity?
Absolutely. So on the utility side, like CMS Energy, it's a regulated utility out of Michigan, excellent earnings growth, but really the utility sector in general. You've seen the independent power producers really do extremely well on the back of some of the nuclear deals they've been signing with the big, hyperscalers, but also the regulated guys are going to have really excellent earnings growth here for the next couple of years at least. So we would point to that as being one example. Another is healthcare on the defensive side. Really, healthcare hasn't done extremely well, and you're starting to see a little bit of the interest in healthcare pick up. China's gotten better, so you're seeing a lot of the tool companies do a little bit better. There's sentiment around China. So that's all very interesting. We'd point to Bristol Myers as a name there that, it's got a big patent expiration gap. The stock trades at 7 times earnings. People want to see some wins on the pipeline, and you've seen that with the schizophrenia drug they just announced approval for from the FDA that had a very clean label. So some of those pipeline drugs are starting to come through. We think those are very interesting. It's extremely cheap. Pharma's out of favor. If you look back to the pullback in early September, pharma did extremely well. And so we think that's a great place to sort of balance your portfolio out.
And that's not a GLP-1 play.
It is not a GLP-1 play, and that's part of the reasons it's 7 times earnings, right?
Fair enough. So that's the defensive part. What on the cyclical side do you like right now?
So there's a couple stocks. I think one is 3M. That's one we've been in for a while. It was a little painful early to start the year. They announced a new CEO, Bill Brown. We think there is a lot to do there to reduce complexity of the business, but also for historically, 3M's a great franchise, and it had GDP type growth. So for the extent that Bill Brown can accelerate the revenue growth of the company, reduce complexity, we think there's a lot of opportunity in 3M. It trades at a 25% discount to industrial peers that we think are equivalent, and so there's a lot of opportunity there.
We were also talking earlier about the ways to play exposure to China and how materials is a good way to play that. Bank of America upgraded the materials sector. Do you play that as, I don't know, a cyclical and a defensive? I don't know.
Absolutely. It's a cyclical play, but I think when you look at how we invest for opportunistic base, we're looking for something that's more than just the macro. We're looking for something within the company. So a name we would point to is Alcoa, right? Aluminum is not the most favored metal out there. It's always copper, but actually aluminum benefits from a lot of the same trends, right? Electrification, et cetera. But it's easier to produce. So it's not the favored commodity. It's not as tight. But Alcoa has actually done a lot to restructure their business. Their leverage is extremely low. They're almost net cash, right? So that gives us a little safety margin. And then also you have some production issues that have happened globally that have tightened the market quite a bit. So we think that is an extremely good play for sort of a little bit of a China sentiment recovery play, but also fundamentals getting better.
I am curious on the China sentiment recovery, and who knows how long this lasts.
Yes.
We're only like a week and a half into this rally, but clearly the mentality right now is that the government has basically made it clear, or Xi Jinping, I should say, has made it clear that at least there's a floor somewhere there. I mean, I don't know exactly where it is. Do you think we're going to return to a healthier growth story for the world's second largest economy, and healthy in a way that is going to attract a lot of outside investment?
I think it's going to be hard to return to the growth rates we had, but that doesn't mean they can't grow, right? And I think the world has to accept that. You think about, the last couple of decades, China was an amazing growth story. So it can grow again. They're loosening policy there a little bit. You're seeing global easing around the globe, frankly, from central banks. Those are two very powerful things. And if you look at the stocks that did extremely well when China started to implement some of their easing policies, that could be the next cyclical sort of a little bit of a nudge for a lot of these stocks that have lagged. So we would point to that as being extremely interesting.
When it comes to value in the AI trade, is there anywhere?
Absolutely.
Okay,
look at utilities.
You gotta be in it. Okay, so that would be your play for AI, but not.
But there's industrials. I mean, there's a lot of plays, and we've been talking about this for a while. That AI was not just the GPU trade. It was not the Mag 7. Yeah. They're the ones spending the capital. Tens of billions of dollars of capital, right? But the beneficiaries are also industrials that provide the cooling. It's also the utilities. The big bottleneck we're going to have in this country is power. The ability to get power to run data centers and keep consumer bills low is going to be the big battle we face going forward.
All right, great stuff. Aaron, this was a great conversation. Really appreciate you taking time for us. Aaron Dunn is the co-head of value equity and a senior portfolio manager at Morgan Stanley Investment Management, helping us count you down to those closing bells. Alex, we're just about 3 minutes away here. You were on assignment yesterday, so you missed the huge sell-off that we saw in this market. Obviously, a lot of people rattled by what was happening in the Middle East. Interesting to see a little bit of a bounce back today, and we heard that from a lot of investors yesterday, that once things settle down there, investors would flock back into equities. Not a big bid, but still.
But a reversal from yesterday. And also when it comes to the oil price, the Wall Street Journal reported that the Saudis would be okay with $50 oil, but it really about putting the screws to, say, Iraq and Kazakhstan because they're overproducing from their quota. So that's sort of, I think, putting a lid down there on the oil price as well. And we've seen volatility tamp down in the oil space, in the bond space, and the VIX right now back below 19. Your yield slightly higher on the day with your 2-year at 3.6. A full breakdown of all the market action today coming up right now, right here on Bloomberg.
The Closing Bell, Bloomberg's comprehensive cross-platform coverage of the U.S. market close, starts right now.
And right now, we are 2 minutes away from the end of the trading day. Romaine Bostick alongside Alex Steele, taking you to the closing bell, a global simulcast. It starts right now. Everybody's back in the pool. Scarlett Fu here in the television studio. Carol Masser and Tim Stenovic in the radio booth.
Reunion.
I know. Alex Steele back from us. I don't know what that assignment was, but she's back.
Secret.
She was up in the wild blue yonder somewhere. Anyway, we welcome all of our audiences across all of our platforms, including our partnership here on YouTube. Carol.
I got to say, I'm going to go there, but the NASDAQ Golden Dragon, man, guys, up another 5%. Have you seen, I know we've talked about it, up about 41% since mid-September, still just up about 23% for the year. But what outperformance. And again, just continuing to see some of the investor enthusiasm.
You know what I thought was funny, too? There was a great note out on this, the potential increases that we could see by Scott Rubner over there. Yeah. I didn't realize how much the Chinese markets were still well below their all-time highs. I think it was like the Hang Seng is still like 30% below its all-time high, which was set years ago. And of course, the mainland indices have never even reclaimed their highs from the global financial crisis.
Which just shows you, right, how much more ground there is to go. And even with the jump up that we've seen in, the NASDAQ Golden Dragon, it is still just up 20% this year, even with that 40% jump like in the last month or so. Yeah, some perspective, right?
Romaine, everyone wants to know, did the iPhone arrive yet?
The iPhone,
you've talked about this on TV.
The iPhone has landed.
I
got an alert saying it had been delivered. Doorman has it. And I'm sure as soon as I walk in the door, a certain person will be all over me asking me to power that thing up.
Do you have the new charging cord yet?
Don't start, man. Don't start.
There's a lot of drama around this iPhone about
$1,000 for a phone and $1,000 for accessories.
Whether the strike would affect it, all of that.
You wonder why this company's a cash cow.
I don't.
All right. All right. Anyway, let's walk you through the numbers here on this Wednesday afternoon. The Dow Jones Industrial Average slightly higher here on the day.
There's a calendar on that
across the
iPhone
board because everything is green on the screen, but the gains are marginal, to be sure. 0.1% gain for the Dow Jones Industrial Average, 0.1% gain for the NASDAQ, 0.1% gain for the S&P 500. And the Russell 2000, it's actually sitting this one out, down about 0.1% here on the day.
All right, to the S&P 500 we go, guys. Not quite an even split, but you had 221 names to the upside, 278 losing ground, and Scarlett, you had 4 unchanged.
All right, let's take a look at how it shakes out when you look at the sector performances. It's pretty clear you've got some big gainers here. Energy extending its advance from yesterday, up more than 1% as oil prices continue to rise. Tech stocks, led by chip makers, up by 0.6%. Financials also squeaking into the green. On the flip side, consumer names, whether you're talking about discretionary names or staples, and we noticed that auto and apparel names in particular are weak. They're down by 0.8%, and communication services lower by 0.4%.
All right, that's the big picture. Let's get to some of the individual gainers. Joby Aviation, guys, just finishing off its highs of the session, still about a 28% gain. Toyota Motor saying it is boosting its investment in the air taxi manufacturer by $500 million to support plans for commercial production, bringing Toyota's total investment in the startup to about $894 million. So big bump up in that one. Sphere Entertainment,
What is the air taxi? Is that just an airplane?
I've been in it.
You've been in it?
No, I've not. I wish. No, these are like EV helicopters, basically.
Oh, helicopters.
Yeah.
But you don't have one?
eVTOLs.
eVTOLs.
Weird.
I know. Me, just taking those Uber stores.
These are the type of thing where they were announced years ago. You're still waiting to see them in the skies.
Yeah, eventually.
Maybe your phone's being delivered by a drone.
Yeah, that'd be nice.
Yeah.
I hope that screen can hold up from the drop.
Well, maybe when they're around, they can take us to the Sphere in Las Vegas. Sphere Entertainment up more than 7% in today's session. Wolf Research upgrading the company to outperform from peer to peer, or from peer perform, excuse me. Sphere has shown early signs of success in proving its core value propositions of being a more utilized, efficient, and profitable venue relative to a traditional arena, and it should benefit as more content is created, allowing it to appeal to a larger audience. And it also says it's not evident to us that another Sphere is fully baked in, so maybe they're thinking some expansion there. So that one, price target set at $60, guys. Stock closing about $47 and is up. Overall, in 2024, stock is up almost 40%. CVS Health up another 1% in today's session, off its highs. We've talked about it this week already. Barclays saying the stock is well positioned for margin improvement after a review of the firm's Medicare Advantage plan offerings for 2025. We know this was a big theme in some of the healthcare names today. Stock, though, is down 20% year to date. We know the other story is maybe what happens to this company going forward in terms of as it looks at a strategic review of options for it.
Okay, let's get to some of the decliners. I do want to start with Tesla. Shares of Tesla down 3.5% today. The company did post its first increase in quarterly vehicle sales this year, though it did let down investors who were expecting more of that bump from China boosting EV car subsidies. The numbers, Tesla delivered more than 462,000 vehicles to customers in the last 3 months. It was up 6.4% from a year ago. Analysts who were tracked by Bloomberg wanted to see 463,900 units. Shares of Humana, wow, all over the place today in the red, down 11.8% at the end of the day. But they were down as much as 24% earlier in the session, the most intraday going back to 2009. The company disclosed the sharp drop in decline in quality ratings for its Medicare plans for 2025. It said the drop will impact quality bonus payments in 2026. We had John Tazzi of Bloomberg News on earlier. He reminded us that Humana has traditionally had pretty good quality ratings and earned bonuses on most of its plans. But as of only 25% of its members will be in highly rated plans that generate extra revenue. That's down from 94% previously. The company is appealing some of these ratings. Also, Humana down 46% so far this year. Finally, Nike. We covered the earnings after the bell yesterday. Its sales in the fiscal first quarter missed Wall Street expectations, but it was an hour later when the real news broke. The company said that it was withdrawing guidance for the year. They cited that leadership transition that's happening on October 13th and 14th. John Donahoe out as president and CEO on the 13th. Elliott Hill in on the 14th. Down so far this year, more than 23%. Down today, 6.8%.
What are you wearing right now?
This?
Yeah.
Oh, this is awkward. Wait, are you talking about shoes?
Yeah. Shoes. Yes.
To look at myself. Oh,
what is wrong with you?
I'm actually wearing. I'm wearing
You
some.
should travel more often. That was really funny.
Me? Oh, it's because I haven't slept.
I got some on my footwear. I got the American-made Wolverines on.
American. Okay.
Yeah, it's
I don't
fall.
know what that is.
It's fall. It's boot season.
Whatever.
Yeah.
All I want are sneakers with stiletto heels. Okay, I'm taking a look at the bond market, and I'm going to hit the FX market for a quick second. So overall, you're seeing a bear steepener within the market, sell-off across the board. The back end, though, rising a little bit more, so you're seeing that curve continue to steepen. But I did want to point out, guys, that the dollar definitely gaining in strength, particularly if you take a look at dollar yen. The yen now weakening 2% to 146.45 per dollar, and we haven't seen that since the beginning of August. Definitely one to point out. You had the new prime minister saying the economy isn't ready for another interest rate hike. So just putting that on everyone's radar for now.
All right. I don't know if this is on your radar, guys, but are you at all worried about your job being replaced by AI?
Yes.
Show of hands.
Yes. Duh. I'll do it too for
Both hands?
Both hands.
Ramin is oddly confident in this. Go on.
No, I'm just hoping that it'll be long gone by the time that thing takes
He's still
over.
phased about the what are you wearing
As the elder
question.
statesman on this.
Yeah,
one.
he's
Oh,
kidding.
sorry.
All right.
Wrong Sue.
Well, listen, this is a great little story. A renowned MIT economist professor actually, Daron Acemoglu. Am I saying it correct?
No.
Asemlu.
Am I saying it correctly, Ramin?
No, you're not, but continue.
Okay. Do you know how to say it?
No.
Okay. All right. So anyway, well, if we had AI, maybe it would help us out here. Anyway, he says that with all this AI hype and all the investments, he says basically that AI can only do about 5% of jobs, so that maybe we're safe. But for investors,
Yeah, but which 5%?
Yeah, exactly.
That's the problem.
Our 5%.
Right.
That's the concern.
The easy 5%.
Here's what he says, though. He says a lot of money is going to get wasted. You're not going to get an economic revolution out of that 5%. We wanted to talk about this story because OpenAI raised $6.6 billion in this latest funding round. It's $157 billion in value. I mean, we're talking like SpaceX and TikTok now.
All right, guys, we got to get to the real story of the day, and that is
I'm
the start
trying to prevent us from going to
Don't go there.
Throw the banners up there. Fat Bear Week has started and apparently ended. Of course, this is the annual tradition up in Alaska's Katami National Park here, where the bears basically start to stock up for winter. They're eating all the salmon. You vote on who can get fattest, but apparently there was bear-on-bear violence that shut it all down just a little bit earlier.
This feels really sad to me. But okay, here's my question.
Yeah.
Did like the world of humans make this happen because we're putting bears together, or is this just a natural evolution of they're both predators and something happened?
I think it's just both predators. Look, this is a small little area. All the sockeye salmon make the migration there. The bears just stand there, catch it in their mouth. I don't know. Maybe somebody got a little chippy, and
I can't.
And, things had
Bears
to go.
are doing what they're doing, and we happen to catch it on camera, right?
I'm going to Levi earnings, guys. I just can't do it.
Oh, okay.
All right. Levi seeing fiscal year adjusted EPS as some outlook at the midpoint of $1.17 to $1.27 a share.
Last time I pick a story.
On the street, that's for sure. The estimate on the street is $1.25. So you already see shares of Levi down almost 7% in the after hours. Third quarter net revenue, that was shy of what the street was expecting, $1.52 billion versus an estimate of $1.55. Gross margin, though, coming in better than forecast. So disappointment here, Scarlett.
Yeah, the company's saying it's going to announce a strategic review of the Dockers brand.
Who still wears Dockers?
Good point. Oops.
Which one are Dockers again?
They're
like
the
little
men's
khakis.
khaki pants.
Yeah.
Oh, men.
With pleats.
With pleats. With the pleats.
Yeah. It's the part of the business that Lululemon's going after, right? With their more comfortable yoga fabric pants for men. No, the khaki pants, the work pants.
All right, as long as you don't have
casual
pleats.
work pants.
Can't do pleats.
Romaine, you wear pleats, right?
Pleats are actually back, believe it or not. Not on Dockers.
But does Romaine wear Dockers?
No, I wouldn't be caught dead at
Pleat,
Dockers.
you kidding?
Yeah.
All right, that's a wrap, you guys. All right, our
If you see me in Dockers, you know the AI bot doesn't want it.
All right, that is our cross-platform coverage. Radio, TV, YouTube, Bloomberg Originals. We do it all from bears, fighting bears, to Dockers.
Yeah, fat bears.
Stop. All right, we will see you again. Same time, same place tomorrow. I think Alex is heading out. She is not going to go buy some Dockers. I know that for a fact.
She's going to get some sleep.
Heck no.
Romaine and Scarlett finishing up on TV, and then we're going to go back to radio. All right, guys, see you tomorrow.
Saying goodbye.
Bye.
Yeah. All right, coming up, a lot more to cover here on Bloomberg Television, including a look at the auto sector. Tesla shares tumbling today after its third quarter deliveries missed estimates, and now getting some breaking news on Toyota, saying that one of its North American EV factories going to have a delayed start. A discussion here about the health of the auto sector coming up next, right here on The Close on Bloomberg.
Welcome back to The Close. I'm Scarlett Fu.
And I'm Romaine Bostic. A little bit of a turnaround from what we saw yesterday. Not much in terms of gains, but certainly not the dour sentiment that we saw yesterday in the markets. We're just going to call this unchanged right now. You had green across the screen for the Dow, the NASDAQ, and the S&P. But again, the gains you saw are pretty much reflective of what you see on this screen, roughly about 0.1% gain or less. You did see some activity in the Treasury space, but I really want to turn your attention to what's going on over in China. Now, it is a holiday in mainland China, but Hong Kong markets are still open. And of course, the ETFs that trade Chinese stocks, that's still going strong. The Crane Shares KWEB ETF up 6% here on the day. And it's kind of interesting. The inflows coming into that ETF as of yesterday on Tuesday, some of the strongest we've seen in years. We haven't seen the data yet for Wednesday, but a lot of enthusiasm right now, Scarlett, potentially about foreign investors heading back into the world's second largest economy.
Yeah, they had largely deserted that market. So even an underweight position means a lot of inflows. All right, let's take a look at some of the day's big movers here. Humana down by 11% for a second day, now bringing its year-to-date decline to about 46%. This is a health insurer that's exclusively focused almost on Medicare, which is now a problem since it saw a sharp drop in its quality ratings for its Medicare plans for next year. What does that mean? It will reduce bonus payments. And according to one analyst, that could mean $3 billion in revenue is at risk. Salesforce.com, the best performer in the Dow Industrials, gaining more than 3% on the day. Northland Securities upgraded the software company, the enterprise software company, to outperform. Why? On the strength of its Gen AI initiatives. It's what investors want to hear. All right, our top story this hour is day 2 of the port strike. The White House is calling on port carriers to come to the table and put forward a fair offer to the union. That's as the work stoppage sparks fears of a renewed bout of inflation, driven this time, again, by supply disruptions. Meantime, Bloomberg Economics says if the strike lasts more than 2 weeks, the knock-on effect could reduce October payrolls by 80,000 jobs, which would then increase the odds of a 50 basis point rate cut in November. For me.
And of course, a lot of people concerned about the potential inflationary impact of that. They should also keep their eyes on what's been going on in the commodity market as tensions escalate in the Middle East. Brent crude right now on a 2-day rally, the strongest 2-day rally going back to August. But more importantly, volatility on Brent crude picking up over the last few months. Just yesterday, it actually traded at a year-to-date high. Joining us right now to discuss where the markets could go next is Rebecca Babin, senior energy trader at CIBC Private Wealth. Rebecca, thanks for being on the program here today. And it seemed like, I don't know, just a few weeks ago, everybody was talking about how low oil might go. And of course, we always have that reminder that geopolitical shocks tend to affect the commodities space and particularly the oil space first before anything else. Should investors start to reprice to the upside?
So that's a great question, Romaine. And let's just put this in context. We have had a move in crude, let's call it 5-6%, since Iran has retaliated against Israel. But we are still very much at the bottom end of the range here in crude. I mean, we touched down at maybe 65 WTI 2 weeks ago, but the high on the year is 85. So we're really still at the very lower end of this range. And I think if you think about what's being priced in, we're pricing in a chance that we see some escalation, some supply off the market. But this is not a market that's panicking too much about what will happen if there is a supply disruption, and that's because they are focusing on the OPEC plus spare capacity that's sitting on the sidelines. That's 4 million barrels. Then that spare capacity is defined as barrels that can be brought on for 30 days and maintained for 90 days. So it can provide a huge buffer to supply disruptions. So I do see the option volatility picking up and the volume, and I think what that represents is the fact that most people in the crude market are actually short, and they're looking at those call options and saying, I'm convicted on my short. I think 2025 looks pretty ugly. I'm not convinced to see a supply disruption. I'm going to hedge my upside tail.
I am curious, so just on that point before we move on, I am curious about, and this is a hypothetical, I know, but if for some reason the war, or the conflict, I should say, between Iran and Israel were to escalate to the point where you did see a real target on the energy infrastructure itself, would that rattle investors more, or is that already sort of accounted for in your outlook?
I think that would rattle investors more. But when we say more, we're not talking about $10 to $15 more. We're talking about $5 to $8 more. And it also very much depends what energy infrastructure we're talking about. There is some speculation that maybe Israel goes after one of Iran's refineries that primarily produces gasoline for domestic consumption, meaning you don't necessarily see a huge amount of their exports impacted as a result of that. It's more of an internal domestic issue. So there's a lot of different ways to slice this, but I think to get to your big picture question is, have we priced in everything if they do target energy infrastructure? No. I think you see another $5 easy on the top of where we are if that happens. But I'll come back to another point, which is I think the market is also somewhat convinced, and this has just been played out over and over again as geopolitical rallies have been faded, that China and the U.S. are putting a lot of pressure on Israel and Iran to avoid including energy infrastructure in this tit for tat. And that's not to say they always listen to what the US or China is saying, but there is still a sphere of influence. And the market participants who have chased geopolitical rallies so far this year have lost a lot more money than those who have faded those rallies or gotten short into them. So I think the market is still pretty comfortable that they don't necessarily see a supply disruption from this. So to your point, I think there would be a reaction, but it would definitely be less than what we would see if we didn't have all this spare capacity on the sidelines.
Rebecca, you had mentioned the short positioning by hedge funds and CTAs in oil over the last month. But given what we've seen the last 2 days and 3 days, basically so far this week, are positions being rebuilt, or are we just seeing an unwinding of those short positions right now?
I think this has been a short covering rally, 100%. I don't think there's a lot of people necessarily getting long and chasing this geopolitical kind of event. As I mentioned, I think when we see the data come out on Friday, there will be a significant reduction in short exposure. If you look at the CTA models, they were triggered yesterday as WTI went through 70, and I think there's a substantial amount of short covering that's happening. To me, though, that doesn't tell me we're necessarily going higher, right? That tells me, okay, these shorts are covering. If we get this event, they're going to reset potentially higher. So I still see this as a opportunity if we get a very outsized move to potentially short into it. Because there really is, a lot of crude on the sidelines. And OPEC Plus, if you look at kind of the nuances behind they seem like they're more incentivized right now to go after market share and to respond to a price increase with supply. They haven't been willing to do that in the past.
Rebecca Babin, always appreciate your insights here on the energy market. Rebecca Babin, a senior energy trader at CIBC Private Wealth. All right, coming up, we're going to take a look at another speed bump for Tesla as the EV maker's first quarterly sales gain falls short. We have more on that next. This is The Close. New developments on EVs. Toyota's delaying the start of production at its North American EV plant and will not begin output until the first half of 2026. This according to a report from Nikkei Asia. Toyota had previously planned to begin assembling a 3-row electric SUV at its Kentucky plant in 2025. Stephanie Valdez Streaty, Director of Industry Insights at Cox Automotive, joins us now to discuss that and Tesla's latest delivery numbers. Stephanie, walk us through what this latest headline from Toyota, which kind of comes on the heels of other car makers also pulling back on their EV ambitions, says about demand for EVs right now.
Yeah, I think it just shows that the market shifting and these manufacturers trying to adjust production to really match consumer demand and the market conditions, right? And we've seen in the data especially Q2 and Q1, that consumers are really starting to look at hybrids and gas hybrids and plug-in hybrids. So I think there's a lot of competition for pure battery electric, and so we're seeing a lot of shifts that OEMs are making around this topic.
Absolutely. So when it comes to actual EVs that consumers are willing to pay for, not the hybrids, what's needed for them to execute on that, for them to close the deal?
I think a lot of it is price is still the top barrier, right? Like there's still a price premium for EVs compared to gas cars, about probably like $9,000-10,000. So we really need more affordable EVs. And I think one of the things that's forcing the industry to sell these EVs, because we're having a record quarter Q3, it's the incentives, right? We've seen 13% of average transaction price for incentives, and that's really driving sales. We're also seeing leasing. Leasing is about 39% of EVs released in June, and that's another way, right? So you can have lower monthly payment. It also gives consumers the opportunity to test out an EV before they actually buy one.
Yeah. Is this sort of what explains the jump that we saw in those orders in Tesla? I know they came in a little bit light, but we're still talking about a company that I think people were bracing to see much lower delivery numbers. And I know anecdotally there's been a lot of evidence of lease deals, incentives here in the U.S. as well as in China. Is that what's driving those sales?
Yeah, I think the incentives, especially if you think about globally, like China, right? Like they've really been pushing subsidies to get consumers to switch over to pure battery, take out their ICE and switch over to pure battery. And I think that's also, the US, the incentives. But I think going back to the leasing, there's some really incredible leasing deals. And I think, as I mentioned, it's just a lower payment. You don't have to worry about, if you're worried about residual values, you're worried about new technology, and so you're waiting for battery technology to improve. So there's a lot of reasons I think people are opting to lease. buy one.
The other component of that, though, as well, and as somebody who was in the market for an EV recently, one thing that was really a topic of conversation in my household was charging and charging infrastructure, or rather the lack thereof. And I know it really varies depending on what part of the country you're in, whether you own an actual single family home and can have your own charger here, but it's still not consistent, right? And I'm curious as to where, if you see a near future, where we're going to have a more cohesive charging network so that people have that comfort level, that lack of range anxiety, if you will.
Oh, you hit on it, right? I think after price, access to charging anxiety is another one of the top barriers. And I think I do believe that in the next few years, we're going to see exponential growth in EV charging infrastructure. You have the National Electric Vehicle Infrastructure Program, $5.2 billion. And that's a goal of 500,000 charging ports in the next few years. So I think we're going to start to see that. It's just a slow ramp up. But I think it's going to be so critical that from a consumer experience, that no matter what EV you have, you go to any charging station, it's reliable, accessible, it's safe, it's easy to pay. I think all those are going to be critical because at the end of the day, for this electrification transition, it's going to have to be, the right product at the right price and the right consumer experience.
So I don't know if this is something that we know just yet, but we're all talking about new EVs, right? What about the market for secondhand EVs? What does that look like? Is there demand for that?
Oh my gosh, yes. That is going to, it's still like 1.6% of the used marketplace. But used EVs are really excelling. Like the last few months, the numbers are small, like 25,000 per month, but we had a 69% year-over-year growth for August. And that just shows you the interest because right now, if you look at the, like we mentioned, price is like one of the major barriers for adoption. In the used EV market, used EVs are very close to price parity with used ICE vehicles. And so I think that's one of the draws is that you can buy a used EV for pretty much the same price as a used ICE vehicle. Yeah. In addition, the Inflation Reduction Act, right? You have that tax incentive. I think that's another also appealing thing.
All right, Stephanie, we're going to have to leave it there. I really appreciate you taking time for us. We're up against a commercial break here. Stephanie Valdez Streaty, Director of Industry Insights over at Cox Automotive. When we come back, a closer look at the port strike going on now and the biggest port strike that took place years ago. This is Bloomberg. All right, let's look back at history. On this day, October 2nd, 1971, the U.S. experienced its first nationwide dock workers strike when longshoremen on the East and Gulf Coast ports joined their West Coast brethren who had walked off the jobs just months earlier in July. 56 ports along the U.S. and Canadian western coast and at least 24 others on the East and Gulf Coast dormant. The unions, on one hand, they were seeking better pay, but more critically, they were seeking to address declining membership and morale as increasing automation decreased the need for human labor. Sound familiar? Now remember, prior to the 1950s, most ships used a so-called break bulk method to move goods by individual units. It was laborious and time-consuming. But the adoption of the modern 8-foot by 20 to 40-foot shipping container meant that rather than unload by hand hundreds of thousands of individual items from the hull of a ship, docks now could only move 10,000 or so large containers from the ship to a rail car or to a truck, which would ferry those goods directly to a warehouse or a store where that unloading could be done on that end. That reduced the man hours needed at the docks, and because the containers were so large, only machines had the power to move them, and that reduced the need for any type of human muscle. After a decade of declines in employment levels, the dock workers said enough. They walked off the job, calling for protections against automation. The strike that started back in July 1971 had become a huge economic problem by the time the East Coast workers joined on October 2nd. The implications range from the serious, refusing to load military cargo needed for the Vietnam War, to the more mundane, such as, well, shutting off salt, rice, and toilet paper shipments to Hawaii. In fact, a 1971 New York Times article said toilet paper became so scarce in Hawaii, it turned into a status symbol, describing how a wealthy heiress received toilet paper as a housewarming gift after she bought a condo in Waikiki, or when a radio station held a contest with a grand prize of bathroom tissue that it cheekily delivered in a Rolls Royce. Now, things were so bad that by October 4th, the President of the United States, Richard Nixon, stepped in, invoking the Taft-Hartley Act to protect what he called the health and safety of the U.S. economy. Eventually, the strike was settled, with the longshoremen getting only about half of the pay increase they sought and none of the explicit protections that they had sought against automation. And that brings us to where we are today, where East Coast workers have decided to shut it all down once again, facing off not so much with the dock owners, but with the technology that threatens once again to further dwindle their numbers.
History repeating itself. And thank you for defining break bulk. I didn't know what that meant, but now it makes a lot more sense. Clearly, it is day 2 of port strikes in the U.S., and President Biden is calling on port carriers to make a fair offer to the union. Our next guest says the most obvious beneficiaries of protracted disruption would be international air freight capacity providers, including UPS and FedEx. Joining us now to discuss is Bruce Chan, transportation and logistics analyst at Stifel. Bruce, thanks for joining us. Before we get to your call on what it means for FedEx and UPS, I'm just curious right now what your base case scenario is, because we're still in the window where if we only get a few days of strikes, the consequences are easily digestible and are unlikely to move the needle on the U.S. economy in a big way.
Yes, that's right. Thank you, Scarlett, and appreciate you having me on the show. That's exactly right. I think our base case here is 2 to 3 weeks. Something a little bit shorter than that, a couple of days, is pretty digestible, as you said. But after that kind of 2-week time frame is when you start to see maybe more pernicious ramifications for the economy. And again, that is about our base case, because we're threading a pretty fine line here from a political standpoint.
Okay, and you say FedEx and UPS will be winners, particularly their air freight business. How much pricing power could they exercise, and are they likely to exercise then?
Yeah, well, they've already implemented peak surcharges. They've already implemented export surcharges from Asia in response to a big surge in volumes from some of the big Chinese e-com players. And, we think that they're likely to capture a significant portion of that. We think they're likely to capture a significant portion of, ad hoc yields as demand for those high value critical process inventory goods, potentially some high value healthcare and pharmaceutical products start to move via that mode.
I am curious, Bruce, as to when we start to see that actually take place. I mean, how long does this strike have to go on before we start to hear from manufacturers and retailers and other folks making these deals with the air freight companies in order to get their goods into town?
Yeah, I think, when you think about a lot of the shippers out there, both on the consumer and on the industrial side, they generally have, a week, maybe a little bit more of buffer stock. So that, could carry us out. But after that point, especially for a lot of the consumables, especially for a lot of the perishables, is when we start to run into some issues.
I've heard a lot of people talk about the perishable side of it, the idea that at least with some of the non-perishable consumer goods, that inventory levels, at least for in certain sectors, are relatively ample. Talk to me a little bit about the perishable sides of this, because I'm not too familiar with, I guess, where I get my, fruit and vegetables and other things. But apparently this is a big issue. Explain that.
Yeah, so if you think about some of the big, fresh fruit importers, for example, like Del Monte, Chiquita, close to 80% of all bananas move in through the East and Gulf Coast ports. And that's not something that, you can carry buffer stock for. So those are the items where, if this starts to stretch out beyond a few days, consumers are likely to start to see price increases and ultimately shortages. Bananas, cherries, coffee. If you think about imported European beer and wine, and then, moving over to the industrial side, if you think about European auto parts, components that go into manufacturing in places like Alabama and South Carolina.
Wait, beer and wine? I need to worry about that?
Yeah.
Asking for a friend.
Maybe.
Yes, beer and wine as well. So given that, and it's an election year, we have 1 month to go before the election. What are the odds from where you sit of the White House intervening and forcing the dock workers to go back to work?
Yeah, well, this is part of the soft science in our 2-week base case call. Obviously, this is a pro-union, pro-labor administration here, and President Biden has already signaled that he'd be unwilling to invoke Taft-Hartley and give the parties a chance to negotiate in good faith. But when we think about, what's at stake here, the parties are still pretty far apart. The ILA turned down a 50% wage increase, final offer from the U.S. Maritime Alliance. I think they're now asking for 61.5%. And there's some bigger issues at play here, too, like a moratorium on any further automation, which, I think is a big sticking point from the terminal operator standpoint. So I think it's likely to be a pretty acrimonious negotiating process after you get to that 2 to 3 week time frame where, you start to see an impact to the consumer. You start to see potentially plant closures or furloughs or layoffs as a result of a lack of inventory for manufacturing processes, that's maybe where you start to see the administration, looking to intervene.
Well, I'm glad. I'm glad you bring up the whole issue here of the automation, because that seems like kind of a non-starter, at least from the terminal operator's standpoint. I mean, you're not going to fight that. It's just kind of the natural evolution of things. But if you believe the ILA president and his rhetoric, he seems like he's willing to sort of burn it all down until he gets that concession. So that brings us back to the question as to whether this will force the administration's hand to step in if you do start to see real tangible economic impact, particularly at a time when a lot of people think the economy is at minimum somewhat fragile.
Yeah, I think that's exactly right. I mean, if you go back to your segment analysis and the similarities between the strike in the early 70s, we're facing a similar situation today. When you compare the U.S. ports to Yangshan in China or Rotterdam, for example, we are significantly less automated. It does hinder our ability to compete on a global basis. If you think about some of the disruption and some of the backlog that happened in the post-pandemic period, at least some of that could have been solved with greater automation. So the union has been resisting efforts to push automation, really since ILA President Daggett's, tenure as president. But at a certain point, that will have to give way.
Let's just go back to your coverage, which is FedEx and UPS. We're also looking at the cost input of oil prices rising and how that would factor into what they charge their customers. WTI at $71 is still down from what it was a year ago at $78. But at some point, if the conflict in the Middle East continues to escalate, prices could easily go up. At what point are you looking at fuel surcharges from these companies?
Yeah, that's another thing that we're watching very closely. Most of the freight carriers out there actually tend to benefit from fuel surcharges, or at the very least recapture them through surcharges. So it does end up being an inflationary pass-through to the consumer or to the shipper. And if we see an extended or protracted port strike, that similarly would be inflationary. So ultimately, this is something that could put pressure, on the Fed, for example, that's looking to thread a needle with the potential for further rate cuts.
All right, Bruce Chan, really appreciate your joining us. Bruce Chan is transportation and logistics analyst at Stifel, saying UPS and FedEx stand to benefit from this strike at East and Gulf Coast ports. All right, in terms of how the markets shaped up on the day, little change and basically unchanged for the S&P 500. So a bit of a recovery from yesterday's risk off and a little bit of unwinding in treasuries as well. But really the story is in currencies where dollar strength is back, or more accurately, yen weakness is in after the new prime minister said Japan's economy is not ready for more interest rate hikes. So they've, put a pause on that. And of course, oil prices up 1.7%, remain still a long way off from where it was a year ago, but something to keep an eye on. Yeah, still holding above that 70 level on WTI. And as far as the Shiba and what's gone over there in Japan, has he talked to the market? Because they're not going to. That's his way of talking to the market. This is the close. It's time now for the top three, where we name drop the people driving some of the day's most talked about stories. And first up is Sam Altman. His OpenAI said it's completed a deal to raise $6.6 billion in new funding. So that leaves the AI startup with a $157 billion valuation. By the way, this deal is one of the largest ever private investments. Yeah, this is a big deal. And of course, Microsoft, of course, are right at the forefront of that, investing about $750 million in the latest round. But what really gets me here is you have to justify these valuations at some point, right? I mean, obviously people are betting. I've seen all people talk about the multiples, saying if this was like a normal price stock, it would take 1,000 years for it to actually justify its multiples. But people are bullish on it. I guess we're going to find out whether this is actually good money being spent. Yeah, well, for now, there's a rush to get in while you can. I'm also watching, or you know what, you're watching someone else. Yeah, I'm watching someone else. This is my line, Scarlet Food. Okay, you go ahead. Adam Newman, remember this guy? So he had a little trouble with WeWork. Of course, he founded WeWork, and then he was out of WeWork. A little trouble. And then he founded his own company called Flow, and now he's founded a new company called Workflow, which is not WeWork. Let's just be clear about this, though.
it curiously seems very similar to WeWork. Basically, co-working spaces, plush couches, everything else. Although he says it's going to be a little bit more adult in the sense they're not going to have kombucha and beer and things like that, like they had at the other WeWorks here. But I guess this is WeWork 2.0. I know he doesn't want us to say that, but that's what it feels like.
Yeah, it pretty much feels like, and that's because his bid to buy back WeWork failed. So it's kind of like he's been backed into this corner, right?
Yeah, I wonder how the actual WeWork, which is out of bankruptcy and still exists, how they feel about this and particularly the name.
Well, I mean, what he's going to say, what Adam Newman is going to say is that this is different than WeWork because what it's going to do is actually build offices in Flo's buildings, Flo's residential buildings, or partner with landlords to manage spaces that it doesn't own. So it's slightly different.
So totally different.
Yeah, just a twist. All right, third on the docket is Daniel Ek. He's the Spotify CEO, and he and Facebook founder Mark Zuckerberg go way back. And while they are friends, Ek says that he avoids competing in sports with Zuck. Apparently, Mark Zuckerberg is intensely competitive to the point of sustaining injuries, which has discouraged Ek from engaging in sports with him.
Yeah, I listened to this podcast, so it was pretty funny. I mean, he talked about, basically said this guy's hyper-competitive on everything, in business and sports, everything. Yeah, he said he used to compete with them in various sports. He wasn't clear exactly what sports they were talking about. I don't know if it was fighting or whatever, but he said it sounded like that was a losing battle for Ek. But they even saying, on the business level, too. He was just saying, like, look, man, he's like, it's just not even worth it. And they're friends. He's pointing this out. It's a friendly rivalry, but he said that Zuck is just very intense, and I guess Ek just doesn't want any part of it.
Yeah, I think he says, I know it'll end badly for both of us, which maybe he's saying out loud what Elon Musk wouldn't say. Because remember, he was challenged to that cage match fight?
Yeah.
Way back when?
Yeah. Elon Musk ain't Dan Ek. Have you seen Dan Ek? Dan Ek's fit. He's tall. He can hold his own against Zuck. Elon Musk is, well, Elon Musk. All right, two other people that we're keeping an eye on. I don't know if they can take any of them in a fight here, but Tim Walz and J.D. Vance, of course, the two men of the moment. They took the stage last night in what is likely the last televised face-off in the 2024 election cycle. Joining us now to discuss what we learned and, well, maybe what we didn't is Mary Ellen Klas. She's a politics and policy columnist for us here at Bloomberg Opinion and has had a long history of covering politics long before she got to Bloomberg. And I want to pick on that expertise here, Mary, because there are a lot of people saying, okay, vice presidential debates don't really matter. But this election cycle was a little bit different, particularly with Kamala taking the reins for Biden at kind of the last minute. And the idea that we're not getting another debate unless something miraculous happens between Trump and Harris. This is it. So when you were watching last night, do you think any voters, any undecided voters, were swayed by what they heard?
Yeah, thanks for having me on. I think this was one of those situations where both candidates went in with a goal to do no harm. And so the fact that nobody got any takeaways that will change their mind probably doesn't make that much difference. And I think that both sides perhaps calculated that. That's why this debate, even though both sides have been bitterly aggressive against each other, this is a pretty civil exchange. And I do think that overall, if you were undecided, you are really in a minority in this country.
Yeah.
And I don't think there's a lot that happened here that probably put you over the edge.
I'm curious about the issue of image. And let's face it, this whole campaign, whether we're talking about the presidential candidates or the VP candidates, it seems to be a lot more about image rather than the actual policies themselves. Of course, Walz has this kind of folksy Minnesota Midwestern charm, and Vance, I don't exactly know what his image is supposed to be, but he's kind of gotten a little bit of a bad rap of being kind of out of touch. Was there any sense here that either one of them was able to sort of reshape that image in any way for the better?
Yeah, I think Vance definitely accomplished that. And he did it by not necessarily being straightforward with what his policy is. But he came across as more normal than he's been portrayed in all these cat lady memes. He came across as a polished debater. His answers were well thought out. His strategy was to turn questions around and not answer them, but use it to employ tactics that allowed him to get into the agenda that he wanted to reshape. Much of his narrative wasn't checked. I think he got away with a lot of misleading statements, in fact, lies. I don't think Walz did a very effective job at countering them. And so I think overall, J.D. Vance's image is the one, he got to walk away, I think, with his image improved. because he had the most to lose, really.
Okay, yeah, that's a good point. But by coming off as this polished debater who, didn't have to take off the gloves and could just do so through smooth speaking, did J.D. Vance perhaps make Donald Trump's performance look worse by contrast?
I think he probably did. And there's a lot of speculation today that Donald Trump was not happy with J.D. Vance because he didn't have any big flubs. He came across as a polite guy, which Donald Trump doesn't do. So there is a perception that those who know Trump sort of feel like, well, he wants another debate because he needs to one-up J.D. Vance. It's ridiculous. And of course, if this is indeed true, we'll find out soon enough. I think in the end, J.D. Vance helped himself, although I think he was able to get away with a lot of things that were not truthful.
What did the Harris campaign get out of Walz's debate last night? I mean, he had a memorable last line on Vance's damning non-answer to the question on whether Trump actually lost the 2020 election. So I know they've tried to put that out on social media and make that go viral. But beyond that, what did they come out of it with?
Well, I don't think Walz came across as a kind of an earnest guy. He's not that polished as a debater. He had some very strong answers in some points, specifically as it related to abortion, and obviously his comeback on January 6th when he basically said, he forced a question at J.D. Vance, do you believe that Trump lost the election, and Vance would not answer it. Instead, he said, I'm focused on the future. That is now a digital ad, and we're likely to see more of that. So that's what the Harris campaign got.
All right, Mary Ellen, appreciate you taking time for us. Great insights here into last night's debate. Mary Ellen Klas, politics and policy columnist over at Bloomberg Opinion. And we should point out the preliminary TV results are in, Scarlett, on this, and about 39 million people across all the networks that broadcast it tuned in to see that debate. Of course, what we mostly assume right now is going to be the last debate of this election cycle.
Did you watch it?
No. I don't watch those things. Come on now.
You didn't watch the presidential debate either, right?
No. Did I miss something?
That one was entertaining.
No, when we come back after the break here, we're going to set you up for some of the potential market moving events over the next 24 hours. This is Bloomberg. All right, as we start to wrap up today's show, let's take a look here at some of the things you should keep your eyes on over the next 24 hours. And we actually start in the next hour later tonight here at 6 p.m. Eastern Time, the premiere of the second season of The Deal with our very own Jason Kelly and a man named Alex Rodriguez. They had a chance to sit down with tennis champion Billie Jean King about why she thinks athletes should learn the business of their sport and beyond.
But that moment, and I feel like that is a key learning, was show up with the money. You found the money.
Well, I know it's about money, but you see, because I was part owner of tournaments with my former husband, Larry, that I understood the business side. Because when athletes come up to me and talk to me, especially tennis players, they go, well, what should I learn? What should I do? I said, learn the business. Learn. And
an absolute legend there, of course. What a treat to sit down with someone like Billie Jean King.
Yeah, a guy named Alex Rodriguez.
Yeah, Jason Kelly's a real star of that show. No offense to Alex, but yeah, definitely check that out later tonight here. And we also have, there you go, that right there, The Deal with Alex Rodriguez, Scarlett, and Jason
there
Kelly.
You go.
All right, a few other things too. Of course, that drumbeat to the Friday jobs report continues tomorrow at 7:30 a.m.
Yeah, we'll get challenger job cuts for the month of September. But what's interesting is the other data points that we've gotten on labor, whether it's ADP or JOLTS, have all indicated the labor market's holding up fairly well, better than what a lot of economists had anticipated.
And we're going to get those weekly jobless claims. And it'll be interesting to see, particularly those 4-week moving averages, how that shakes out, whether we see any softness there. And then a slew of data, I guess, in the manufacturing space, if you will.
Yeah, but it's not going to reflect anything with the strike. So going forward, these numbers will be really interesting for the month of October. Factory orders, durable goods. We won't get that until the end of the year.
We also get the ISM services data in there, too. Maybe some illumination there. And more illumination, Scarlett, from Fed speakers.
Oh, my gosh. More Fed speak.
There you go. You got to read them off. Jeffrey Schmid, Neil Kashkari, Raphael Bostic, the second favorite Bostic on this program. We'll be back tomorrow. Please join us then. In the meantime, stick around. Balance of Power is next.